Hello, everyone. I'm Andy Voles, Clear Street's Chief Commercial Officer. This is our last panel for today. Afterwards, we have Michael Saylor. Obviously, I think we've saved the best for last. I'm joined here by three entrepreneurs who innovate in the thematic ETF space, Ryan Bader, Will Ryan, and Greg King. I'm just going to give them each a chance to briefly introduce themselves and their companies. Ryan, why don't you go ahead and kick us off?
Yeah, perfect. I'm Ryan Bader. I'm at Tidal Financial Group. I'm head of capital markets there. We're a ETF white label issuer. We have about 325 products on our platform across about 90 different issuers and about $50 billion of AUM. Multi-asset class across the whole platform. We look to bring products to markets and launch them, keep them active, and then obviously grow them as well.
Hi everyone, Will Ryan, founder and CEO of Granite Shares. We're an ETF issuer based out of New York. I started the company almost 10 years ago, and in that time we've grown to be a global company. We manage on any given day 12 to 13 billion across multiple asset classes and strategies.
Hey everyone, good to be here. I'm Greg King. I'm the founder and CEO of Rex Financial. We also have a sister company called Osprey Funds that's our crypto brand. I've been in ETF issuance for about 20 years, working for first the big banks and corporates, and been entrepreneurial for 15 years. Co-founded a company called Velocity Shares earlier, which we sold. The theme to my career and my business is really alternative strategies, alternative exposures, anything that's outside the purview of your kind of 60-40 stock bond world. Good to be here.
Thanks, guys. Let's just start with a kind of a general question. So, these I call them thematic ETFs, but they're levered ETFs, they're inverse ETFs, they're blended ETFs. This is a fairly new product, I think, particularly in the US. And obviously it's an innovative product, and the product is constantly innovating. So what excites you guys about the future of this ETF product? What's coming? And where do we think this industry is going? And then Greg, I'll kick it back to you.
Sure. So, I mean, there's a lot wrapped up in that question. So, for example, leveraged ETFs have been around since '06. So the concept of a levered return in US ETF space is not as new. What is new, though, is that's been applied now to even down to single stocks. Both Will and I do a lot of that. So you can have a levered NVIDIA, for example, which nobody wants today, unfortunately, but maybe tomorrow we can try again. So the space, I think it's exciting because we've had, if you've been involved with ETFs for a long time, they were kind of boring back in the day. They're great for investors, low fees, diversification, et cetera. But for the guys like us or me, I'll speak for myself, we're looking at commodities or crypto or leverage strategies. It was hard to do a lot of this until probably 5-6 years ago. Some of the rules changed. We're able to do a lot more. And then even more recently, this year, so the rules changed around crypto regulations. So the space is just mushrooming. So I think that's exciting. It's also exciting that other jurisdictions, I'm probably stealing one of your future questions, sorry, but other jurisdictions want to participate. And so the US market is not just catering just to the US, but also more globally.
Will, same question.
Yeah, I mean, so the ETF is just the investment wrapper of choice that's replaced the old technology, which was the mutual fund. So that's been going on for 30 years now. And then, as Greg said, it meets a confluence of better wrapper, constantly evolving regulation. So rules are changing, market environment's changing, which leads to more trends. And then lastly, which again is relevant to this event, the market's gone global. So increasingly, it's not just about a US customer anymore or a customer in North America. It's a global customer who is accessing ETFs, and typically US ETFs, on a smartphone from somewhere in the world. And all of that leads to new product opportunities.
Thank you. Ryan, just layering in, so the topic of the panel is ETFs in the digital asset era, and I know you have some experience there. How would you also kind of loop in digital assets into this ETF journey that we've been on and the innovation in the industry?
Yeah, I think it's really the progression, and the progression we can look back 25 years or so and say that we launched the most common sense product that we could possibly think of being the S&P 500 on within a 40 Act structure ETF that's publicly available to everybody. And then we went into sectors, and then we went into thematics, then we went into leverage, as Greg just mentioned, and we've expanded that continuously. We've done call writing on top of it. We're doing auto callables now in so many different formats. We're taking a lot of the hedge fund mentality and bringing it into a 40 Act structure and launching those products successfully. So if you look at the digital asset and the crypto world, I think we're very early innings in that innovation. So if we're looking at, we brought a Bitcoin product to the street, great. We have Bitcoin, we have Ethereum, we have Solana, we have some of these individual products. We're starting to maybe hit the tip of the iceberg with some of the other innovation. I don't think we've quite gotten to a place where we can really thoroughly say that we've completely investigated all these different spots. And I think there's a lot of innovation yet to be determined here.
I guess as a follow-up to that question on the innovation side, what leads someone, and I guess I'll go back to Greg, what leads someone to want to buy NVIDIA on a levered basis or Bitcoin or really anything that could traditionally probably be purchased in another way via an ETF? What are the advantages, and I'll ask all you guys this, what are the advantages that the ETF brings to that transaction?
So I think it boils down to convenience for a lot of people. You know, an ETF is one of the most convenient ways to get exposure. As you go through as a builder in capital markets, you realize all the different constraints that different groups have, whether they're institutions, they have one constraint, you know, wealth managers have different constraints, retail has other constraints, and these constraints by definition make their life difficult in various ways. ETFs solve a lot of that. They don't solve everything, but they solve quite a bit. And so it's a pretty simple thesis that ETFs have been exploiting for 25 or 30 years. As it relates to leverage, I think one of the convenient facts around levered ETFs is there's no recourse to the investor. The individual investor in a margin account has to deal with posting margin and worrying about all that. And the ETF just auto resets daily in terms of leverage, and that is super convenient. Anyway, there's more to say, but I've got two other guys.
We'll follow up.
Yeah, I mean, it's convenience. Trust is a massive part of it. I've heard a lot of people talk today in the context of Bitcoin that buying Bitcoin clearly was available from the beginning, but everyone got excited about ETFs because sometimes it's that extra bit that extra bit of learning, that trust in an entity that may or may not be regulated. You're doing something that you're not familiar with, but ultimately, what people want, in addition to the convenience, is they want trust. They just want to be able to buy it in the same brokerage account that they buy everything else in, the same portfolio statement, etc. And that really is what the crypto ETFs have done, just like the ETF wrapper has done for multiple assets, going back since the beginning. So convenience factor is massive. It's the trust. It's the highly regulated nature of the wrapper that just gives people that extra, I think, confidence that they can put this in a portfolio along with other assets they have.
And Ryan, so I know that all three firms represented here have pushed for changes in the regulatory space and things that make some of these products possible. What is the industry, what is the innovative ETF industry pushing for to kind of bring that next version of the product?
Well, I think there's a lot of different avenues you can kind of take there. I think to the main point that Will and Greg made is about the trust. If you have the ecosystem that's there and the custodial relationships, the prime brokerage, the swap dealers, the FCMs, and all of these things are well known and trusted for a long period of time. And to take the next step is to have a better and more direct connectivity into some of the digital asset custodial banks and stuff like this, because they are still a step down in comparison to the U.S. banks of the world and the BNYs of the world, at least for the broader broker and broader, Charles Schwab style asset manager. So you're looking at making progress with some of these maybe like operational aspects of the business. I don't think there's a massive lift here with the regulatory piece, but getting that trust, simplifying the platform, and allowing everybody to have the same type of purchases within the ecosystem, and the ETF allows that. The ETF simplifies your purchasing platform, your taxation. It allows you to have trust in your custodial relationships. All of these things are already established, and you don't really have to think too much about it. Versus when you go completely digital asset away from that, you have a couple additional layers to kind of unpack. But there are some innovation things that we could still, add on to. Cryptocurrency trades 24/7. ETFs do not. I think we are making some progress there with going into something like Blue Ocean, who Samsung purchased a couple years back, and 24/7 ATS. But that's not going to completely, backfill all of these things. We don't have every cryptocurrency or every digital asset available through an ETF, and I think we're pretty far away from that still.
I can add something to that. That's hopefully interesting to people. It's definitely interesting to us. So one little, I don't want to call it battle, one little issue that's emerged is going past 2 times leveraged ETFs back to 3 times and even 5 times. So I don't know how many people follow the ETF industry closely, but there were 2 and 3 times leveraged ETFs that were launched in between 06 and 08. That was when they first got approved, wildly successful, et cetera. But the SEC had a number of questions around market impact and so on. They basically put a moratorium on issuance of these kind of products for years while they studied it, and eventually came out with a rule that allowed for 2 times ETFs to be issued, but no more. Recently, there's been a push by a few firms to see if they can kind of push the envelope to 3, and then 1 or 2 have filed for 5, which I'm not holding my breath on. But it will be interesting to see if the SEC sort of re-allows 3 times leveraged ETFs, because that could cause another explosion of new product and innovation. There's a lot of kind of nuance behind the scenes on whether that's going to happen or not, but that is definitely, you asked, I think your question was like, what's the ETF industry pushing for? Not everyone is, Vanguard's not pushing for that, but some of us are.
Well, I was going to give Will a loaded question, because I wasn't even going to bring that up, because I somewhat know your opinion on it, but what do you think the risks are of the 3X, the 5X, the X arms race, so to speak?
I mean, hopefully the risks are kind of fairly obvious that as you take more leverage, then there's more risk of loss if you're an investor. I think the challenging part of this is that it's not a fair or not a level playing field currently, because what Greg was saying is exactly right, but within the context of the new rules that came out, existing 3X ETFs that existed were grandfathered in. So you still had 3X ETFs, but Greg and myself, Ryan, couldn't launch a new 3X ETF. So that doesn't feel right. Then there are other parts of the market, they're not directly ETFs, but other products that look and feel quite similar, which are already at 4 times leverage. If you go to the European market, 3 times leverage is common, 5 times leverage is also relatively common. So there are these sort of distortions all over the place that it would be helpful if there was sort of more unification around the rules. So that being said, clearly there's an area where people think there's an opportunity to do that, to bring more product to market. And again, just with more leverage, there'll be more demand, more interest in bringing a new category.
Ryan, any follow-up thoughts on that?
I think I would just add that I think there's a balance that the SEC will acknowledge that they also have a fiduciary responsibility to the investor to keep leverage and or something kind of at a certain level for them within their portfolios. So, getting up to 5X or even 3X in certain products is certainly an investment risk, I would say. So the whole point of 18F4, which Greg was mentioning, is to keep that at roughly 200%. And if the SEC is going to adjust that, they need to adjust that universally and not for grandfathered firms like Direction and ProShares. So they need to make that adjustment and acknowledge that there's going to be a free market within multiple different asset and leverage levels, or they need to simply accept that 18F4 was put in place for a reason, and they're going to accept that 200% or 2x leverage is the mark.
Thank you. So we talked about overseas a little bit, and I know we've all talked about sort of what ETFs can provide access to, like the Korean market, for example. Greg, what are your thoughts on ETFs really being a delivery vehicle for strategies and trades that aren't available kind of in local markets, and how much of that is already sort of driving the ETF business, and what do you think will happen from here?
The way that impacts us is really with leverage products. So probably 15% of our AUM we think lives in Korea. There's a trading culture there. They have great pipes and plumbing back into the U.S. market, and they can sort of work during the day and trade at night. Maybe hit the bars and then go trade.
That's always a good idea, but it's a great strategy.
But no, and it's not just Korea. There's other markets in Asia that are, I think, much more interested in these high octane type ETFs than the average American. So for us, it's a very interesting market.
So Will, Greg said 15%. How does that 15% become kind of 30% from those markets? And do you think that's one of the main drivers of growth?
I think it's, first and foremost, there's a reason why that's happening, and that's if you look around the world, there's Chinese tech, which arguably for a lot of people is uninvestable. There's no European tech, and so you're only left with the US tech. And so if you're an investor in Korea or in Japan or whatever, there is only one Tesla, there's one NVIDIA, there's one Meta, and they're here in the US. So if you want to trade those with leverage, you have to come to the US market to do that. So that's kind of the why. And then back to an earlier panel about Tom Lee's trips to Korea every quarter. I think we might be on the same plane. But everyone's just trying to court the same investor audience, that this is just like in crypto world. For us, it's a global market. You go where there's demand for your product, and where you have a large retail investing base, digitally savvy, likes to take risk. Those are all markets that we actively play in, and Asia's certainly got that demographic, and we're all trying to capture a share of it.
And I believe, I think this is correct, you might know, but I believe Korean investors typically aren't paying any capital gains tax on these trades.
That helps massively. And yeah, typically you find that there is a very positive correlation between countries with high retail trading populations and zero taxes.
Yeah, exactly.
Well, that makes a lot of sense, and that would lead to kind of a follow-up question. What's the effort to sort of drive these products into the Middle East, into Dubai, into Saudi Arabia, which I think are both going through sort of a similar proliferation of interest in U.S. equity trading that the Korean market did and the Japanese market did? And Ryan, I don't know if you want to kick that off.
I'm not overly familiar with that, Andy, so I'm going to go pass.
We're exploring it. I mean, it's
Yeah.
definitely kind of the next frontier. So that's a very interesting spot to branch out and start marketing.
Yeah, there are a lot of pockets around the world that are, in the next 5 or 10 years, are going to be massively interesting. And again, it's all the same phenomenon that people can trade ETFs on a smartphone from almost anywhere. And these kind of Robinhood lookalike businesses are springing up all over the world, and where there's an active retail investing population. Crypto's been a big enabler of this as well. People now trading crypto, they're buying stable coins, whatever it may be, and then the next leap is buying stocks or ETFs.
So kind of moving specifically to crypto, I mean, do you guys feel that sort of tokenization is potentially a challenge to the ETF structure? If you could tokenize a short or tokenize a lever, what are your thoughts on that specific digital trend?
Yeah, I think that the eventual tokenization of stocks is certainly a possibility. They really need that large market cap, firm, Apple, Meta, et cetera, to tokenize their actual single stock. I would make the assumption that the lobbying against that from a NYSE or NASDAQ would be massive. But that would really be one of those stepping stones for digitalization and globalization of the entire platform. And now you have that, to Will's point, on your iPhone in your hand, and you can trade any asset 24/7. So the digitalization and tokenization of global assets, and all of a sudden this opens it up further when you're saying that it's challenging to buy a single stock in mainland China. If they tokenize, it's not. You can all of a sudden purchase this this vehicle relatively easily. Is it more likely to probably go ETF first? Probably, because the pushback from the capital markets space within cap tables and things like this could certainly fight the digitalization of some of these large market cap firms. But somebody will eventually do it. I don't know exactly who, but whoever does it will lead the way, and it's going to change things, I think, rapidly.
Greg or Will, any follow-ups?
I see it a little bit like the case for stable coins, where the stable coin, like the real value, really came from outside of the US first, and particularly in emerging markets and places where there was like a real, the dollar was the product. The stable coin was ultimately the way that people facilitated that much more easily. So, in a way, I see the same thing with tokenization, that if it does take off, in our world in ETFs, I think it's going to come from markets where it's very difficult to get access to capital markets, just period. And a token solves an issue for people that, where there's no current infrastructure or limited current infrastructure today to support that.
That was actually my follow-up question. It seems like, I agree with you when Eric was talking about the stablecoins, it certainly seems like just giving access to dollars outside of the US more easily will make people want more dollars or consume more dollars. It's got to be the same thing with ETFs, equities, et cetera.
I think it can help fix a timing mismatch problem, classic ETF that holds international equities. You have different cutoff times for creation baskets and things like this that, to me, when I think about tokenization of equities, it's just everything now trades 24/7, right? I think the rollout will be very messy, country by country and sort of rail by rail, if you will. But eventually we'll get to a point where everything's 24/7, and that enables us to innovate as well as get our own, because we're like a derivative, right? We're a stock that holds other stocks, basically, each ETF. So there's sort of the tokenization of the things that we're buying, and then there's the tokenization of our own shares.
Mm-hmm.
But it'll be interesting to watch how it rolls out, and I think there's going to be some pretty big winners, but they're more in the market structure space than the product issuance space.
Probably last question, I'll start with Ryan. Ryan, what do you see as sort of the intersections? We're obviously spending a lot of time today talking about this digital asset treasury, which is an area that we've been focused on. But what do you see as sort of the intersection of ETFs, digital asset treasuries, SPACs, crypto native ETFs, and where are we going? And I'll ask the same question to everyone. And if also, what are the challenges? Like, what's missing to prevent firms like yourselves from launching the products that you want to launch?
It feels probably like a stepping stone thing. I think we kind of have to take a more simplistic step initially, and part of that's going to be around what was just mentioned with the stable coin. And I think a fairly easy path for a stable coin to find a place within mutual funds or ETFs or other more generic places would be with like a stable coin money market fund or something like this. You can have that type of asset class immediately inserted into something, trades 24/7 with no problem, has complete liquidity, settles immediately on chain. So you have this excess and next step that you can take, but it's also really simple. That's not really a big ask. I think that when you start to move away from or into more complex structures, you're going to find more bumps in the road, and that's going to be obviously more challenging.
Will?
Well, I think from our perspective, I've always viewed our job as an issuer is to give the people what they want. So we don't necessarily take a view on whether something's good or bad. It's more trying to read the market and provide access to what people want as an investment. So if people want DATs, or if people want certain cryptocurrencies, if people want, then it's our job to do that and try and figure out how to crack the code from a regulatory perspective, to the extent that that it's not, it doesn't fall within the generic rule set. So it's really more about reading the market trends and understanding what people want and try and give them access in the ETF wrapper.
Thank you. And Greg gets to go last, so say whatever you want. No one else gets to respond.
Perfect. I think for us, one of the most interesting future developments or kind of areas of focus is being able to combine equities, crypto, and derivatives in one ETF. I think there's a lot you can do with that. The new rules that allowed crypto ETFs to kind of launch automatically, so to speak, do not allow for that. So there's still some innovation required. But that's a big focus of ours with our Rex Osprey product line. Everyone go Google that. And
Good plug.
I think, you said I could go last. So for us, the convergence of crypto exposure as well as certain equities that maybe, DATs or other equities that have exposure to the crypto space, coupled with crypto and/or equity derivatives like options where you can tweak the performance, that's a very interesting space. So I would be watching that space.
Perfect. Thanks, guys.
Thank you.
Thank you.
Appreciate it. Thank you.